Hello and welcome back to chapter 21, first chapter in section 5. This is a long chapter. It will explain the business finance, sources of finance, and many ways that the business might use to finance its activities. So we have many details in this chapter. This chapter is one of 5 chapters in this section. So we study about the needs of finance, the sources of finance. We'll compare the sources of finance and we'll talk about the advantages and disadvantages of each one. You'll see many new concepts, many new terminologies in this chapter, so make sure you know all of them because they will help you in understanding chapters 22, 23, 24, and 25. So first, I have to know what is the role of finance department. Of course, the department is very important in the business, as any other department like marketing or sales or accounting. Finance department is a department responsible for recording all financial transactions, everything related to payments and sales and expenses, everything related to final accounts like income statement and balance sheet. And this is what we will cover in chapter 23 and 24. Finance department is responsible for cash flow, management of cash, and this is also will be covered. This will be covered in chapter 22. Finance department is responsible for making financial decisions related to the sources of finance, sources of money that the business should have, and this is one of the major roles of finance department. So why businesses need finance? Why finance is needed? Why we need money? Probably, of course, we need finance for several reasons. So first, businesses will need finance if they want to start up. So the money that we need to start up a business is called the startup capital. Of course, this is the money that we need to start up a business. We need money also to expand the business, new branches, new products. To deal with difficulties, if we're facing a cash flow problem, for example, if we're facing any crisis, very low sales, we need to cover our cost, of course we need finance. So probably we need finance for 2 main reasons. We need finance to pay day-to-day business expenses, like the wages, like the salaries, like rent, for example. All these are called expenses. And we call them revenue expenditures. However, the money that we spend on buying machines and equipments and building and vehicles and all these things, we call them capital expenditure. So, of course, there is a difference between the two. Revenue expenditure, the money you spend on day-to-day business expenses. However, the money you spend on buying fixed assets like vehicles, like building, like land, like equipments is called capital expenditure. So if you look at this table here, you notice that we have different types. So let's just do it together. Purchase of building, of course, it's capital expenditure. The building is a fixed asset. It's something that we own and it's not for sale. All these terminologies will be covered more in chapters 23, 24, and 25. Water rates, of course, revenue expenditure. It's an expense. Office computer, we consider it as a capital expenditure. Gym equipment, of course, it's a capital expenditure. Maintenance of the equipment is also related to the capital expenditure, or it's a payment also for maintaining the fixed asset. It's called capital expenditure. In business, you don't need to know more details about these. You only need to know the difference between the two. In accounting, however, you have many details related to these. So for those who studied accounting, they know that recording capital expenditures and revenue expenditures will be somehow different. Now, let's start with the sources of finance. When I talk about finance, I have 2 ways to differentiate between them, the internal and external, and short-term and long-term. So we'll start one by one. So let's start. Internal sources of finance, I mean when the business gets finance from within the business itself. So I'm not using an external party to get finance. So probably I rely on retained profits. These are the profits that the business keeps after paying all the expenses and taxes and interest and all these things. This is the profit that we keep. The word retained means the word keeping, or what I keep. Sales of non-current assets, sales of equipments, Sales of machines, of course, assets that we don't need. Sales of inventories to reduce inventory levels. Also, this is a way to finance the business. And there is a fourth one, which is the owner's saving, of course, what the owners have, and they invest probably in the business. So let's start. Retained profit is a common way for businesses to finance their activities. Of course, it's an internal source of finance. It's the profit that is blocked back, or it's a profit that is kept in the business after we pay dividends and taxes and all the expenses. So many businesses will rely on retained profit, of course. The good thing about it that you don't need to repay it to anyone. There is no interest. It's your money. It's your profit. However, many businesses, especially new businesses, they don't have retained profit, or the retained profit is low, so it doesn't allow me to expand, or maybe the business is simply making no retained profits at all. The second one is called sales of assets. If you have unwanted asset, if you have something you just it's old, for example, you no longer use it, so you simply can sell it. Once you sell it, you can use its money. Of course, there is no cost on the business at all. It won't increase your debt. You raise maybe a lot of money if the asset value is high. However, the disadvantage, like it takes time to sell, especially if I'm selling a building or a big land or whatever. And as simple as that, it's not an option for many businesses. Because if I'm a new business, I won't sell my assets as I need them. The third one, sales of inventories to reduce inventory levels. The inventory, of course, it means the stock of goods that you have. So the business might sell its inventory, make maybe discounts on its inventory to sell more inventory to raise cash. So I can reduce inventory levels by doing this. But the disadvantage, like sometimes customers will be disappointed because they don't have, the business, of course, is running out of stock, and customers are disappointed because there are no goods kept. Now, owner saving, the fourth one, it's the money that the owners put into the business. Of course, savings are number one source of finance, especially for sole traders. It's available quickly. You don't need to pay interest, of course, but many businesses or many sole traders or many people, they have low savings, and they don't prefer sometimes to take risk into using this source of finance to invest or to expand their business. Now, external sources of finance, the most common external sources of finance, or the finance that we take from outside sources, outside parties, the most common is a bank loan, of course, as we know, but we have many others. So we have debt factoring, we'll explain, bank loans, issue of shares, debentures, microfinance, grants and subsidies from the government. All these are called external sources of finance. So let's start with the first one. Issue of shares is a source of finance only for limited companies. And here you have to understand and concentrate once they ask you about sources of finance, because issue of shares is a source of finance only for limited companies, private limited, public limited. It's not a source of finance for a sole trader, because simply sole traders and partnerships, they don't have shares to sell. They are not limited companies. So here, the money that you obtain from individuals, of course, the good thing about issuing of shares, it's a permanent source of capital. It's a capital that needs not to be repaid to anyone, right? There is no interest to be paid like a bank loan. However, you have to pay dividends to shareholders. And of course, these dividends should be paid on yearly basis, and they will be deducted from your profit, right? All the shareholders will expect to get dividends. And maybe when you issue shares, especially in public limited companies, the ownership of the company could change, so you might lose the ownership. But still, it's a common way for limited companies to raise finance. Bank loan, of course, bank loan, it's common when you borrow from the bank, and you will pay the money back with interest. And for those who don't know the interest, of course, it's the cost of borrowing. So you borrow money from the bank will say, okay, I'll give you money, but you have to pay an interest. You have to pay a cost on this borrowing, and it will be a percentage, 1%, 2%, 3%, it depends. The good thing about bank loans that they are quick to organize. You can take them for 2 years, 3 years, 5 years, 10 years, it depends. If you are a large company, you can benefit from low interest rate. And if you can link, this is what we call economies of scale. If you remember economies of scale, there was something called financial economies of scale. So if businesses have a large scale of operation, they can somehow easily get a loan from the bank with a low interest rate. But the disadvantage is clear, you have to repay it with interest, and there should be something called collateral. The bank won't give you a bank loan or a loan without securing it, without giving the bank a collateral or a security, so that you tell the bank, if I don't pay the loan, you can take my security and sell it. So there should be a security there if I want to take a bank loan. Selling debentures. Debentures are a common way also for limited companies. Debentures have this characteristic that they are certificates. Of course, limited companies issue to raise very large sum of money. That's why the good thing about issuing debentures or these certificates to people to buy is that you raise very big amounts of money, and they are long-term finance, like for a long period of time, 25 years probably, or maybe 18 years, maybe 20 years, but usually it's up to 25 years. However, of course, they should be repaid back with interest. So I'm getting money from people, I'm giving them a certificate that I owe them, and I'll pay them the money back with interest. And the holders of this certificate will be given right to sell business assets in case I fail to pay them back. Factoring of debts, I didn't see any question related to it in the exam, but I'll explain it. Factoring of debts means when customers take a long period of time to pay you, you have a lot of money with these customers. So you can go to any company, for example. This company is called a debt factor. It's a specialized company. They just take your debts and they go collect them from customers, but they pay you immediately. So, for example, I have $60,000 debts with my customers. I go to a company, I tell them, please collect these debts for me. They will go collect the debts for me, but they will take a percentage. So maybe they give me immediate cash like $50,000, and they take $10,000 as a fee, let's say. So this is what we call debt factoring. Of course, the advantage, I have immediate cash, and the risk now is on the company, not on me. However, I have to pay a percentage of the debt. I won't receive 100%, of course. They will take like commission on it. Grants and subsidies, of course, I'm talking about the government now. Sometimes the government will give me a grant, which is not repayable, or will give me a subsidy, which is repayable. So simply this will help many businesses, especially the startups, to grow, but the disadvantage is strings attached, or I mean here that the government will give you a help, will give you subsidies, will give you tax cut, will give you maybe a free interest loan, but they will tell you you have to locate in certain areas. The government will do this just to force businesses sometimes to just go and locate in certain areas. So because the government wants this area to have somehow low unemployment. Microfinance is an important concept. Microfinancing means in low-income developing countries, if some people wants to start their business, they won't be able to get a bank loan from the bank, because usually commercial banks won't lend people who want very low amount of money. First, because they cannot gain profit from them. Second, they don't have a security. So small business owners won't be able to start their small business from getting a loan from commercial banks. So that's why we have somehow specialist institutions. They meet the financial needs of these people. Grameen Bank in Bangladesh is an important source of microfinancing. We have many foundations all over the world, like Kashif Foundation in Pakistan is famous also in supporting low-income people. So they give a loan to amount of money or a loan to entrepreneurs, and of course, these loans will be repaid after a period of time. But here we are talking about a loan with maybe $100, $70, $200, so we're not talking about a big amount of money. But this is what we call microfinancing. Now, we can classify finance into two other things, the short-term and long-term finance. Same sources of finance, we can classify them, and we'll add like 2 or 3 more. So short-term finance and long-term finance. Short-term finance, we have something called overdraft, debt factoring, we already covered this, and the trade credit, a new one. And long-term finance, we have something called leasing, we have something called hire purchase, of course bank loans, and issue of shares, and of course selling debentures. So as you can see, we can classify loans with under two categories, short-term and long-term. So look at this and to differentiate between short-term and long-term. When I say short-term finance, I mean the loans that the business expect to pay within a year. So this is a short-term finance. I take a finance and I expect to pay it within a year, and that's why I call it short-term. However, long-term finance is a finance that usually use it to buy non-current assets, a building, lands, expensive equipments. All these require a big amount of money. That's why I need a long-term finance, the finance that I don't expect to pay within a year. So, of course, there's a difference. So let's start with this. Overdraft. Overdraft is very common. Many questions in the past papers about overdraft, or you'll see this word in many places. Overdraft is simply an arrangement with the bank manager. It allows me as a business to withdraw a sum of money which is greater than the balance that I have in my account. So let's say I go to the bank manager now. I tell him I cannot pay the salaries this month, or have a problem in paying salaries or paying my suppliers. I want an overdraft of $5,000. So the bank manager will arrange it and will give me an overdraft. Of course, it will allow me as a bank to withdraw more than I have. So here, the advantages are clear. Of course, I can pay for my wages, for my suppliers. I can arrange it quickly with the bank. Usually it's cheaper than loans. Of course, there is an interest I have to pay, but it's cheaper. However, disadvantages, there is still interest rates, and I have short time to repay. Like it's maybe for 1 month, but it's flexible, not like a bank loan. So it's a short-term finance. Trade credit is very simple. Trade credit simply is delaying the payment to suppliers. So you don't have money now, to have enough money available to pay your short term. That's, you just delay payment to suppliers. So this is what you do. The good thing that you can have money now, you can use it now, right? But sometimes suppliers won't allow you to take goods, or they might refuse to give you the discount. Of course, you will not get a discount if you're late to pay, right? So it has its advantages and disadvantages. Factoring of debts, already we covered this, and we consider it as a short-term finance as well. So now we have 3 ways of short-term finance. Now long-term finance. Long-term finance, of course, the finance that I don't expect to pay within a year. I expect to pay it within 1 year to 5 to 10 years. So the first one is bank loan, and I always prefer to call it long-term loan. Don't call it bank loan. Every time they ask you about it, just say long-term loan. We always assume that bank loan is a long-term finance, by the way. So of course, you know the advantages and disadvantages. The main disadvantage that you have to pay interest, of course, and there is collateral. So bank loan is one. Hire purchase is a long-term finance. What is hire purchase? It's simply when the business buys a fixed asset, let's say a car or an equipment, over a long period of time, and we pay monthly payments, of course, with interest. So this is common, of course. We can do this. Businesses can do this as well. We call it hire purchase because we don't pay amount of money now, so we don't need large cash to purchase the asset now. However, of course, we have to pay a cash deposit at the beginning, and there is interest to be paid, of course. So hire purchase is still a way, but I can use it to buy a car or an equipment for 4 or 5 years, and I do this. Leasing is a common way, of course. Many of you, they know leasing. It's really common in USA and Canada, as I know. Many people, they use leasing. Also, businesses, they use leasing. Leasing is simply different, of course, different than the hire purchase. Some students, they mix them. Leasing, it's allowing the firm to use an asset without purchasing it. So, for example, I need an equipment. I go to a leasing company now. I lease the equipment. I take it. I start using it, and I don't purchase it. So there is no purchase here. I'm simply using the machine, and there is a leasing period. At the end of the leasing period, I return back the equipment to the leasing company. So in this way, I'm not paying money, right? The leasing company will make maintenance, right? There is no large cash sum is needed to start with, right? But of course, I have to pay like to the leasing company every month, let's say. So of course they will take interest. Sometimes it will be expensive. So let's say if I'm leasing a big machine for, let's say, 5 years, at the end of 5 years, I might pay more than its actual value, but still, it's a good way if I don't want to pay a large sum of money now. Okay, for selling shares, of course, this is a long-term finance as we stated before, and remember, and always remember that this is only available for limited companies, not for sole traders and partnerships. Common mistake in the exam where students just say issue of shares. You have to know what is the type of the business in the context or the case study in paper 2, so that the business will take finance based on its type. Selling debenture, of course, this is also a long-term finance, and it's clear that raising large sum of money for a long period of time. So now I differentiated between long-term finance, short-term finance, internal and external finance. There is something here I just want you to know. It's called debt financing or equity financing. So remember that when I take a bank loan, I have a debt. I have to return the money back to the bank, right? So there is no change in the ownership of the business. You simply have to take a bank loan, and this bank loan should be paid, of course, back to the bank. So here there is an interest that will be charged, so your costs will increase. Remember this. But in equity financing, it's a source of finance. It's a way of financing the business where the business sells shares. So when I say issuing of shares, I'm talking about equity financing. However, when I take a bank loan, I call it debt financing. So selling shares, of course, as I said, you don't need to repay to anyone. And the correct word here is called permanent source of capital, right? But the limitation will be that you have to pay dividends, of course, to shareholders. It's sometimes expensive to sell shares, especially in a public limited company. And what happens when we have an increase in shareholders? We have something called dilution, or the ownership will be diluted between different people. So I might lose ownership if I use this way in financing the business. If you look at this difference between short and long term, let's do it together. Of course, overdraft is a short-term finance. Debentures, long-term finance. Issue of shares, long-term finance. Bank loan, as I said, always say long-term loan, which is long-term finance. Trade credit, it's a short-term finance. Hire purchase, it's a long-term finance. Why it's important to know the difference? As I said, because finance depends on many things, and we will talk about it now. So we have many factors that influence your choice. The legal form and the size of the business. Sole traders and partnerships are not like limited companies. Remember this. The amount required is also important. Do you want a big amount, large amount, a small amount? So what is the amount that you need? Length of time. If you need a finance for a long period of time, probably you will sell shares or debentures if you are a limited company. But if you need the finance for a short period of time, probably maybe you'll arrange an overdraft with the bank, maybe you delay payment to suppliers. So see, remember that businesses will simply look at many factors. I look at existing borrowing. Remember, the bank won't give me loans if I have already loans with other banks. So I have to ask myself, if I have already a bank loan, so maybe it's not an option now. Maybe I have to find another way to finance my activities. The risk, remember this is what is related to the bank loan, because probably if you look at a business and you see more than 50% of its capital comes from a long-term loan, this business might be at risk. So this is what we call risk. Also, this is considered, and this is somehow related to the banks and their, let's say, acceptance in giving us a bank loan. It's good to know these points. The most profitable business, the easier to finance the activities, and it's clear now that retained profit is used. Banks usually lend profitable businesses. They won't lend businesses with poor cash flow, with losses, with the business that has already loans, with the business that has no securities. The bank will not lend these businesses, of course. Shareholders buy shares if the share price is increasing. And when you sell shares, of course, if your share prices are increasing, shareholders will somehow want to invest in your business, and the opposite, of course, true. So that's all for finance. So let me give you some hints. First, you have to know the differences between the sources of finance. In the exam, the way they ask, most of the times they ask you to recommend sources of finance. I always suggest you know the advantages and disadvantages, because it's common to ask you recommend a way to finance the business. I have to know that some businesses, they don't sell shares. Don't do this mistake. Just mention a source of finance without knowing if the business can do it or not. Many questions in past papers are repeated. So I know we have many terminologies in this chapter. Just read them and read the advantages and disadvantages, really important. Understand the meaning of overdraft, understand the meaning of microfinancing, understand the long-term finances, the short-term finances, the differences between the two, because it's important to understand how businesses look at finance and the sources. In chapter 22, we'll talk about cash flow forecasts. So we'll talk more finance. Many terminologies, as I said, try to be familiar with these terminologies because they will help you in other chapters. Okay, so that's all for this long chapter. See you in chapter 22.